right, Tim Quast is back with us. How we doing, Tim? It's good to get into it. Talk a little market structure edge. How we doing?
Good to see you. Thanks for the couple weeks off. I kind of needed it.
We all need it sometimes,
I
We
man.
need some time off
yeah.
after this
Oh man.
this last week for sure.
Yeah, it's
Right?
been
Right?
definitely a tough day with the situation that's been going on. Of course, we can get into the conversation how that affects the markets. What will you be looking this week, Tim?
Well, Mitch, it's the markets don't seem to have a lot of a lot of propensity to hew to what happens geopolitically. We're talking about what's happening with Israel and Hamas and maybe Hezbollah. We'll see. The one thing that stood out to us ahead of this event was very high short volume market wide. Look, the market was at a statistical bottom. We talked about it last week to edge users that we felt very confident that the market would offer some good trading opportunities, particularly in tech. I don't think that those are gone. But to me, the telling feature will be short volume, the supply side of the market, not the demand side of the market. We'll see.
Now, of course, interest rates have risen and tech stocks were rising on Friday. But what's going on? It just seems like there's a lot of conflicting noise in the market right now, Tim.
Yeah, well, the orthodoxy is that tech does poorly when interest rates rise. And I guess the thinking there, I don't buy into that notion because I don't think the market has worked that way for quite some time. But I think that the notion is that if interest rates are high, it diminishes the interest that money may have in chasing risk. I mean, if you can park your money in cash for 5%, why would you risk losing 10%? If you look
I've been given that argument for a while here now. It's why
Right.
I'm half cash in my long-term portfolio, because I get paid to be in cash.
It absolutely. The counterpoint to that is that you always have to keep this in mind, traders. You got to know how the market works and what the money is doing, and this is how the market works and what the money is doing. There will always be, and until there isn't, I guess, a certain amount of money that is going to be committed to equities in models. And this is how the market works today. Most of the big institutional money, and I'm talking about BlackRock, Vanguard, Fidelity, State Street, UBS, JP Morgan, Morgan Stanley, I could rattle off additional names. They're principally following models. You probably have money with those folks. I have managed accounts. We tend to follow an allocation scheme. How much do we want committed to equities versus other forms of investment, fixed income, alternatives, real estate, all those sorts of things. And there is a certain chunk of the money that will continue to go through retirement vehicles into equities. And where does it go? Well, it's going to disproportionately go to the biggest stocks because they are stable, they have less volatility, and they have a lot of liquidity. And that will disproportionately benefit tech, large tech. I mean, Tesla and Amazon are 43% of the consumer discretionary index. It's
What index?
Yeah, I know, it's crazy.
That's not an index, man.
Right? Exactly.
Yeah.
So they're going to benefit. And that's why we say, well, just look at the supply-demand balance. And when those things are improving, that's where you want to be. When they deteriorate, you should put your money in cash. And right now, we've had a nice few days. I had a very good trading week last week, trading things like AMD and NVIDIA and other big tech. But I think it could be a short cycle, looking at the supply side.
Yeah, and if we look into the markets, right, we've had some rallies on Friday, and the S&P 500 still down significantly here. And if you look into the sectors, there's some sectors that are screaming goodbye, as we saw the utilities down big, real estate down big, staples down big. Where's the safety trade? Is there any safety trade? And what's really going on underneath the hood here, Tim?
Well, so if you look at real estate and utilities, they're very small parts of the market. I think that that's part of the problem. If if BlackRock is allocating money to the market, what proportion of it is going to go to real estate and utilities? Well, not much, particularly when there is a disproportionate amount going to fixed income because you can produce a return from your capital. I mean, why would you buy illiquid real estate and utility stocks if you could buy liquid Tesla or Amazon or Nvidia? And I think that that's a problem. Consumer staples, it's difficult. I can look at the supply demand balance here. I'll show you, in fact, and you can see what the problem is. Bear with me here 1 second.
Let's do it. Let's do it. While I give the chat here, I'll give you guys, of course, you guys know we're using Market Structure Edge. You guys check it out for yourself. I'm throwing up the link here. Get your 2-week trial, man. Get it now.
It's actually a month. You can use it a month. No risk. You don't have to, just
I've been getting, I know they're using it out there, Tim. Other shows, I've been hearing messages, hey, market structure is saying this. I'm like, all right, well, thanks for the insight, right? We got to know the good stuff, man. Let's take a look underneath the hood.
Hey, it works. And it's certainly not because I know something. It's that there is a cadence and calendar to the market, and there are rules that govern how money gets into and out of the market, and you can see it. So going to, staples and discretionary are right next to each other. And this is how I think about these things. There's demand, the top graph, and there's supply. And when they're diverging, as happened right at the end of August into September, this was a good time to trade consumer discretionary. And you could produce some nice returns. The moment that deteriorates and demand wanes and supply rises, not a good time. Maybe it's like I saw in the chat, that's a good time to sell premium. If you can see that demand is just not there and there's too much supply, well, it's a good time to sell volatility to people who don't know those things. And if I look at it right now, the demand side of discretionary is okay. It's at 5. That's the bare minimum. That's just matching supply and demand. If supply is above 50% and rising, it's going to be very difficult for those stocks to rise. And so probably you should sell some premium on that group. If you look at staples, it's even worse. Weak demand, supply is not quite as high, but it's rising too. Weak demand, high supply, not good. Until those conditions change, either short or sell premium or find something else. And, you could look at big tech. This is what we saw a week ago. Big tech had falling, here, I'll zoom in on that, had falling supply. See this? This was the bad time. Right at September options expirations, you don't want to be in tech. But at the transition from September to October, demand was, or supply was very low and demand bottomed and rose. And that is oftentimes where you can get a return in tech. So AMD is a great example of this. One that you don't tend to put with big tech, but it behaves very much like big tech, and it's more volatile, which means instead of getting 2%, you can make 3 or 4% at a time. I traded it over and over. It went up to 104, then went back to 100. I bought it, went back up to. I just did that over and over. So it's a way to play those trades, and so you can see this is still pretty good. The thing to watch is if the supply side begins to outpace the demand side, clearly prices are going to stop rising. And if you're long, then you don't want to be exposed to that. And once again, maybe then that's the time to sell premium. But that's what we look at. And if I look at, there's the only thing. Is there momentum in the market? Not really. There are 4 stocks in momentum. One of those is Nvidia. There are 11 in low volatility. Again, could you?
What are the other 3 in momentum? We always like to see your momentum.
You got it. Yeah. So
we had 0 in there a couple of weeks ago, so at least we got a couple.
We went for almost 2 weeks with nothing in it. So there you have it. Moderna is in it, believe it or not.
Wow.
Nvidia, SMCI, SE. These are challenging stocks to trade because they're one's an ADR, American Depository Receipt, I believe. SE is. Yeah. Yes. And those things are challenging because they're heavily arbitraged and they don't necessarily do what you expect. So be careful. I mean, if I'm picking out of this, I could keep returning to Nvidia. I mean, you could make $17 per share on Friday in Nvidia if you just
Yeah,
bought
it's
it fairly early,
ridiculous.
right? It's just crazy.
It's that, and we have
Yeah,
a headline
crazy.
here in Nvidia, and we're getting a dip here again because it's talking about Microsoft coming out with an AI chip they were kind of talking about on Friday. So you come back with the Nvidia here, dipping here. It seems like just when Nvidia dips, there's just so much underneath demand in this stock that
Yep.
you just can't break it. I don't know if it's money managers that just don't know which AI plays, but they know Nvidia's one, and they just keep scooping it up on the dip. I mean, SMCI, which is another one which was in your filter, which I was long for a
Yep.
bit too, and I just sold recently because it's rallied up quite a bit here in the last week or two. I mean, the dips keep getting bought in this stock too. So the AI story is still out there, even though the market has gone ice cold. The AI story is still out there. You can see it in those stocks.
Yeah.
Absolutely. And if you're looking at it from a market structure standpoint, this is what you look for. You look for rising demand, the green part of the graph, and it's hit 10 now, and falling supply. Almost always, particularly if the stock pulls back some, you're going to have an opportunity to make a reasonable part of the volatility. And now Nvidia has almost 5.5% movement every day. That's just between the highest and lowest prices. So if it's down 3 or 4% at the open, the probability that in the next day or two you can produce a nice return is mathematically very, very high. When supply starts to rise, that's going to deteriorate. And that's how you manage risk. You're just stacking the probabilities in your favor that you can produce a return. And does it have anything to do with fundamentals? Well, that's an input. But it's really these short-term imbalances in supply and demand that give you the opportunity to produce returns.
All right, Tim, let's wrap up with just the overall market outlook. We haven't taken a look at the overall market. I'm sure it's going to be similar to that big tech, but let's take a look here. Let's see how supply is moving up. And can we really kind of sustain a rally back from these 420 area, or will we be going lower? What is it showing us on the data?
Well, okay, so if you're new to Edge, this is the gray part of the graph, the one that's more volatile, that's price, and it's SPY. It's a proxy for the S&P 500. The smoother green line, that's tallying up demand. 10-point algorithm that meters buying and selling by investors. There are 4 big behaviors plus price that make up that algorithm. And then down below is short volume, the data set associated with the modified uptick rule. It's a great way to understand supply in the market. When demand drops below that green line, literally 100% of the time in the data set, all the way back to 2010, the market has risen. But it can be very short term. I mean, could things change very rapidly? Yes, and here's why. If the supply side were falling, I would say this is a very durable rebound. But the fact that supply is 51%, the market is more short than long. And so it's like climbing a hill. If you're in a car and you press the throttle, you've got thrust, which is what demand is, but the hill is fighting against you. And that's kind of where we are. I think this is a reflection of, if people get cautious, if they turn cautious about the situation in the Middle East and the potential for it to expand. I mean, the world feels very tenuous right now, and it's a terrible thing that has happened there. Somebody's going to have Israel's going to have the will to win this thing, to restore order. But this is bad news. If this continues to rise, we're going to see a double dip here. And I don't know what's going to happen. I just watch the data. And then you have to shorten your time frames as a trader when you see these things developing so that you're not caught out and all of a sudden, your trades turn negative.
What I like about this is also, Tim, is sometimes as traders, we always get like kind of our subjective view, right?
Yep.
And one of the best things I think is important is also taking a view of your subjectiveness of the market, but also then looking at quantifiable data to seeing if those two views are matching. Because that's what I like to do, is try to match the variables, right? The technicals, the story, the fundamentals, but even better, kind of short supply, looking into demand, things like this, I think really help when we can put those things together.
Absolutely. And great segue to Israel is Danny Kahneman and Amos Tversky. Danny Kahneman won the Nobel Prize in economic theory for their studies. And, they're Israeli PhDs who studied confirmation bias, our natural human inclination to believe what we think. right? We do that. That's what we do as
Yeah.
human beings. And you have to be very aware that we all are subject to it. And
Yeah,
and
for
it's
sure.
challenging. We commit and we believe something's going to come true, but you got to step back from that and do, as to the best of our ability within the constraints of human nature, use math, because math brings objectivity to the equation. And that's all. The only advice I could give you is you try to rely on math, because math won't lie to you.
That's what we'll go with. If you guys want to learn a little bit more of Tim Quast and, of course, Market Structure Edge, I threw up there his link for Market Structure Edge. Get that free trial and give my man a follow on Twitter. Always good to have you.
And come join us on Thursday, 2:30
There
p.m.
you
Eastern
go. You
time.
got
We'll
to.
we'll,
Nice.
we'll talk live about using the data effectively.
Hey, well,
It's
you get
fun.
Market Structure Mondays here, but if you want Market Structure Thursday, you might want to go over to my man Tim. Have a good one, Tim. Always good to have you. It's good to have you back, my friend.
Great to be with you guys. Thank you very much. Have a great
Thanks,
week.
Tim.
All right, let's get back to the markets. How we looking here, Joel?
Just quiet here, just chopping, if we didn't have the events over the weekend, you say, hey, this is Columbus Day, you're gonna have a little bit of a